Hi everybody, welcome to the Leeb.com video for August 10th, 2010. That's Leeb.com. Today, of course, was the much anticipated meeting for the FOMC, the policy setting arm of the Federal Reserve. First, not surprisingly, the Fed decided to keep interest rates at record low levels. And second, the Fed decided to go with what the media is calling quantitative easing light, basically just reinvesting the principal payments from its mortgage holdings in treasury bonds instead of a larger purchasing initiative like in March of last year. Of course, the last time, the announcement of the large-scale debt purchase program caused a remarkable stock market rally. This time around, at least so far, the response has been more subdued. Although stocks did rally off their intraday low, they finished the day off the high watermark for the day. And looking to the Far East, China will also join in fun and conduct a new bank stress test of its own. Last year, it already tested its banks with the assumption of home prices falling by as much as 30%. But this time around, China said that it will make the test even more rigorous, testing the ability of its banks to withstand home prices falling by as much as 50 to 60% in cities where prices have risen the most dramatically. Frankly, China's tough standards make Europe's recently completed stress test look like a farce. While the move does suggest that Chinese policymakers may be concerned about the health of the real estate market in China, it also shows, as usual, the communist government's preemptive and no-nonsense approach to managing its economy. The severity, it should be noted, of the adverse scenario to be used in the stress test is more a case of policymakers wanting to make sure that its banks can handle the worst-case scenario rather than a case of them actually believing that a 60% drop would really happen. Home buyers in China are required to pay significant down payment. For example, at least 30% for first-time homes of larger than 90 meters and 50% for second homes. So there's less reckless consumer behavior than what occurred in our own country during the housing boom. And also, the communist regime has far more direct control over its economy than our own government does. And without political bickering, it will be able to do whatever necessary to prevent a banking crisis. Even if the housing market does crash in China, a view that we do not agree with, the impact will be much smaller than what we saw in our own country. So despite what naysayers say, we still recommend investing in China. Thank you for watching. Join us again soon.